quick video from Trade with Jeremy. So I'm Synthetics Jeremy, and for the course of this video, I'll be your teacher and your tutor. So for today's video, I just want to do a quick breakdown of a trade idea I had this morning. Today is Monday, I think November 17th, right? And today I had a trade idea for gold that I've been struggling with it all morning, mostly because the market is waiting for FOMC, so there's not a lot of volume, but it's holding significantly. And so I just want to take you guys through how I got the trade idea and my entry and all of that. And so I'll just quickly come down to a lower time frame to show you. This is it. This is it's a buy on gold. This was my first entry. This is my second entry here, right? I'm targeting this liquidity level here, and I'm actually going to be leaving way before price gets here. The reason being that this is a bearish opposition level. Price could sell when it gets so close to this point, so I'll be taking my profits early on. But currently I'm waiting. I want to see price break out of this point here, then I can have full confidence in holding till these levels. This first entry is on a prop account, and this second entry is on a live personal account. So how did I get this trade idea? Let's dive right in. I'll come up to the weekly time frame. Last week Friday, due to the hawkish tune of the US Fed, gold sold. There was a huge dump on gold, so I'll be restarting the whole analysis all from the beginning, right? So we have this on the weekly time frame. You can see that when price got to this level, this particular price level, we had support, we had price bouncing back up, and we can see usually there's this formation, this candlestick formation, where it looks like you have one candlestick that digs into an area of liquidity or a point of interest, and then it rejects, and then you have a second candle, and then you have the third candlestick heading in the direction. So we have this 1, 2, 3 candlesticks, right, looking like a U-turn. Price is making a sharp turn or a U-turn in the opposite direction, right? Now this level, I like to call it my rejection low, because this is the low that rejected from whatever point of interest or whatever support or demand that okay, sorry, I see why. Whatever support or demand that caused price to start buying from there. So I'll mark this area as my rejection low. Yeah, because the low that rejected, right? This is my rejection low. Now this is previous month's high, and it also equally serves as a current all-time high, right? And so if price is buying, our liquidity targets, because we have to always mark our liquidity. If you watch the first video, the videos I've released so far on bias, on how to know what direction to trade in, liquidity is one of the ways to know where price is heading in, right? And liquidity also acts as target. So this high there, that candlestick wick, the high wick of that candlestick is liquidity, and liquidity pulls price towards itself. And so if price is buying, price is likely heading toward this point. Price is likely to reach here, then reach here also overall, if the market remains bullish, or if anything happens fundamentally that causes price to keep being bullish and keep buying, right? So on the weekly time frame, I see this, right, and we are within this range. My trades are going to be within this range, this high and this low. If price goes below this low and the candlestick closes below it, it invalidates any form of potential bullishness, and so we start looking for sells down to around this point here, this fair value gap right around here, right? But if price takes this out and takes this out, then we are in a bullish market. That's one of the reasons for marking out these levels, rejection lows and rejection highs. And then so if I go down to my daily time frame, now you can see that price created a mitigation block, and this was a swing movement from this low to this high, right? This is an impulse move or an order flow leg, a bullish order flow leg. Now on the bullish order flow leg, we have a fair value gap and we have a fair value area. I'll release videos on all this. If you don't know what what a fair value gap is or a fair value area is. So we have this this year, this high year for we had this retracement that started from this high to this low before price, but the high of it is our mitigation block, right? And it's also an overlapping gap because it overlaps the week of it overlaps directly with our the fair value gap on this bullish order flow leg, right? And so this is my daily mitigation block because it's on the daily time frame, right? And you see that price retraced into this point, and you see the rejection. Right, Friday evening, price got in here and rejected, right? And we started seeing price buying back up. Let me take this over here. And we started seeing price moving up, buying, all right? And so coming down to the 4 hour time frame, what I wanted to see this morning was I want to see signs that price is respecting, is respecting this. That we see this 4 hour, this 4 hour, the week of this previous 4 hour candlestick, right? And on Friday, the way the market closed, price closed like this. Let me show you how price closed. All right, this was Friday. This all happened on Friday, around from 9 Nigerian time, 9 p.m. Nigerian time till 9 a.m. Nigerian time, or yeah, no, I think this is from New York session. It should be around 4 5 or 2 1 2 4 5, right? Nigeria time. Um, so, because I'm currently using New York time now, so it's currently 7 past 7, New York. So my first entry was this was rejection displacement from this point of interest, from this PDRA, from the mitigation block, right? And so my first entry was on this order block here that price left, right? This other block that price left. Although initially when I spotted it, it was just a 15 minutes mitigation block. Right, so I will still mark it out as a 15 minutes mitigation block, right? And that's what I used for my entry. And you can see I sent the signal out on Friday on my free signal channel. This was Friday, all right. Uh, this was when price had started nearing the daily mitigation block. I said if this plays out well, next week will be a better trading week, right? Because last week was shitty. So price got here, and I sent the entry. This 15 minutes mitigation block, right? This is it. This was the entry before price had made those extra moves up before it came back down today, this morning, right? Price got in there, and voila, we're in profits this morning. This was this morning. So this was Euro USD buy on USD that I also sent this morning. So this was the entry. Price got in there and started buying, and then I got the second entry also. I'll show you guys how I got that. I did all that, but basically, yeah. So this was it. This was the first buy entry, right? And so my first buy entry was here, and my stop loss was, I think, just underneath this point. Targeting first of all this high is here my target. Then this on the 4 hour time frame, we have a place where we could see price selling from, which is here. So this is my target around here. Around this point is my target. Okay, I think this is my stop loss. So the second entry I got, this second entry here, this was how I got it. The same principle again. Now, because we just got into New York session, right? Well, because there has been not enough volume in the market, price has been ranging and consolidating. But what I've been using to get entries have been the order blocks that price leave on the initial displacement, right? And so this is the initial displacement here. Let me shift this entry here. So this is the initial displacement here, all right, and it left behind an order block. Let me use the rectangle to mark this one this time. This order block here that we can see on the 15-minute time frame, and that's where my second entry is from, because I like to always leave my bias being what it is, right? Until price goes beyond my invalidation points, my bias remains solid. So this is my second entry. This is my second entry here. For gold, I don't use to cover the lows or the highs with my stop loss, because if for gold, if price is going to if price is going to respect my entry and it's going to be a good trade, it doesn't dilly dally. Gold doesn't dilly dally. It doesn't go in and out. It doesn't, most times it doesn't even reach to your SL before moving your direction, right? If it's a good trade, gold will move in your direction almost immediately, right? And so price has not, despite the price has been consolidating or accumulating, price has not really come back to our previous entries, right? So first entry, second entry, this is how I got them, right? Using order flow legs. But basically, the entry on this trade can be gotten anyhow. But the major thing about this trade is the analysis, the higher time frame analysis, right? You can see clearly on the higher time frames how price how it aligns with how the structures align. So this is, if price is going to continue being bullish, this is the first low, this is the low, and this is the high. Normal uptrend market structures of higher highs and higher lows. So this is the low, and this is the high, and hopefully price is creating a higher low here to create a higher high, right? And if price is going to keep buying, it's going to create another higher low and a new higher high. So this is my trade idea for today, and this is how I got it. All right, so if you enjoyed the video, it's been insightful, like subscribe, leave a comment, ask questions, and I'll answer them in the comment section. Right, so thank you for watching this video.